Good day, everybody. Hope your day is starting off well for you. Today we're going to spend most of our time moving into Chapter 12, which, as you can see from the PowerPoint, deals with the next accounting cycle, purchases, payable, and payments processes. Before we do that, I would just like to speak to the second group project, which I have now distributed to you. So you should be able to find this in Blackboard resources. And what I decided to do in this particular course was to have you do an internal control assessment. So I have given you some facts for a company called the Robinson Company. And there's a description, essentially a one-page description of their accounting system as it relates to billing and to cash receipts. And so your task is to review those facts and identify the internal control weaknesses in this company. So what I would like you to do, remember there's a billing cycle and a cash receipt cycle. So based on the information, you should be able to identify a number of internal control weaknesses. Now on the group project sheet that I sent to you, you notice at the bottom of the sheet there's a table. And so that's what I expect to receive back from you, is that completed table. Now on the table that you see there, there's only 4 weaknesses listed. But what you should be able to find, you should be able to look for 10 internal control weaknesses in the description for Robinson Company, okay? And as I suggested in the instructions, you should have a look at the internal control questionnaire that we talked about for Chapter 11, which of course dealt with the revenue receivable receipt cycle. And you can use the internal control questionnaire and look at the company's set of facts and try to discern what the weaknesses in internal control are. This is the exact same process that an auditor would be following in a client situation. It's also the same process that you as a management member would be following if you were looking at your own company's accounting function and determining whether the internal control was good or poor, and then trying to identify what the weaknesses are. So again, the internal control questionnaire, because when you look at it, you'll note, as we talked about in Chapter 11, that the internal control questionnaire talks about the assertions made, completeness, accuracy, etc. And so those are the areas in which you should look for weaknesses, okay? So essentially, list as many weaknesses in internal control as you can find, but at least 10, okay? Now, when you find those weaknesses, again, looking at the table, the second column says potential result of weakness in internal control. So if the internal control is weak in a particular area, what is the accounting error that could result? So for example, overstatement of sales, or valuation of accounts receivable, okay, or theft of cash, or those types of comments is what I'm looking for in terms of the potential result of the weakness in internal control. And then finally, the right-hand column, now that you've discovered a weakness in internal control, how would you improve internal control? And in order to improve internal control, you want to find a way to reduce the risk, right, associated with the weakness in internal control to an acceptable level. Or if we can't reduce it to an acceptable level, maybe we can eliminate the risk altogether, right? So auditors are about finding risk and eliminating the risk by perhaps changing the internal control, or reducing the risk associated with a particular control by, again, making a change with respect to the accounting processes, for example, okay? So those are the types of things that I want you to attempt. So you'll have 10 weaknesses, you'll have 10 potential results of the weakness in internal control, and then you'll have a total of 10 recommendations. Again, you can, if you can identify more than 10, that's fine. But I would challenge you to find at least 10, okay, in this set of facts. When you look at the internal control questionnaire again, keep in mind you're looking at a complete cycle, right? Billing, accounts receivable, right, and cash receipts. So you've got three different components. So when you look at the internal control questionnaire, right, finding 10 weaknesses might sound like a lot, but you have to look at it from a perspective of first billing, second accounts receivable, and third cash receipts. So in theory, it's sort of only about maybe 3 weaknesses in each of the 3 areas. Okay, so it might not really be as daunting of a task as it might appear. Again, in terms of the organization and your submission, I suspect you'll be able to get the table onto one page, but if not, I've allowed 2 pages. Again, you can use landscape, okay, when you, in terms of your formatting, when you send it back to me, just attach a cover page, again, with your team members and your student ID numbers, okay, so it's easy for me to identify your project. Again, if you have any questions at all while you're completing the project, send me an email, please. And if there's anything that's important for the entire class, of course, I'll let the entire class know what the question was and what my answer to the question was. Okay, so good luck on that. Again, it's an unusual task, so many of you, I'm sure, will probably find it fairly challenging. You've probably never done anything like this before, but this is a real learning exercise. And it is, because it's essentially a hands-on exercise, right, in the nature of a case, this is really something that you would be doing in a real-life scenario, as I mentioned, as an auditor or even as a member of management, right, in an organization where you see weaknesses in internal control, and you might be able to make recommendations to your colleagues about how internal control could be improved. Okay, that being said, let's move into chapter 12, which, as I mentioned, is referred to as the purchases, payables, and payments process. Sort of, in the past, I've sort of called this the triple P, right? Purchases, payables, and payments. And so if we think about this in the ordinary context of a business has to do what? Has to purchase things, doesn't it? What types of things does a business purchase? Well, we may purchase services, right? Accounting services, legal services, insurance services, all different types of services. And of course, we may purchase product, right? So we may purchase raw material, right, for input into our manufacturing process. We may, of course, in addition to purchases of inventory-related items, we may also purchase, of course, capital assets. So we may purchase different types of equipment or land and building, right, for us to carry out our selling process or to conduct our manufacturing business, if that's what we're doing. Right, so when we think about purchases, it actually involves quite a few of our normal business activities. So normally I don't do this, but I'm just going to look through the learning objectives for this chapter. Given that we've already covered chapter 11, you'll see that the layout and format of chapter 12 is quite similar to 11. And when we look, of course, at 13 and 14, you're going to see that those are quite similar in terms of how the authors follow the approach. Okay, so we'll just look at the learning objectives for a minute. So the first one says, describe the purchase, payable, and payments process, including the risks, the transactions, the account balances, the source documents, and the controls in that process, right? So of course, before we can analyze and understand anything, we have to understand what does the process consist of, right? So there are transactions, right, carried out in the accounting process. There are account balances. Which account balances are we talking about, right, in this particular cycle? Well, when we purchase something, right, it might be inventory, it might be a capital asset. when we purchase something, we have a debt, right, created, an account payable, or if we borrowed money, right, a bank loan payable. And then, of course, we have to make a payment. So debit accounts payable, credit cash, right? And so we're constantly following this cycle. So we'll have transactions, of course, account balances. We have to have source documents. In the billing receivable receipts cycle, we need things like sales orders, sales invoices, accounts receivable listings, right? Various types of computer management reports we saw, right? There's a lot that goes into that cycle. Well, the same thing here, right? We're going to need some type of source documents in order to process information. And then as far as controls, what types of internal controls should we have in place to ensure that our accounting information is complete and accurate, and that, of course, it's reliable for decision making. The second learning objective says describe the auditor's internal control risk assessment and control tests for auditing control over the purchase of inventory, purchase of services, purchase of fixed assets or capital assets, and for the payment of cash. Of course, we have to pay, right, our accounts payable. But in this second bullet point, we're going to look at the internal control risk assessment. Why do we have to look at that? Well, we have to assess the risk associated with internal control because it affects the nature, extent, and timing of our substantive procedures. And you always have to remember, right, from an auditing perspective, we are talking about the two different types of procedures: internal control tests and substantive procedures. And as we've discussed previously, substantive procedures consist of test of detail. That's when we're going to, again, source documents to verify information. And then analytical procedures, essentially where we're doing ratio analysis, comparing balances this year to last year, this quarter to last quarter, etc. Okay. The third bullet point, it says describe the substantive procedures used to respond to the assessed risks of material misstatement in the main account balances and transactions. So as a result of our assessment of risk associated with internal control, we're going to plan our substantive procedures. I think we always have to remember, if internal control is poor, that means that there's a fairly high risk that the system will fail to detect and correct material errors in the financial statements. And so from an auditor perspective, when internal control is weak, we've talked about the fact that auditors must do more substantive procedures in order to keep the audit risk at or below 5%. On the other hand, if the internal control risk is low, that means the internal controls are working well and that they should detect, prevent, and correct material errors in the financial statements. So in that set of circumstances, the auditor can reduce, right, the amount of substantive procedures they do, which of course reduces the audit effort in terms of time. And remember, management definitely wants to have a good system of internal control because, one, it produces reliable financial information on which they can make decisions, but then also, secondly, the internal control objectives will help to ensure that the company operates efficiently, effectively, right, in terms of achieving its goals, and that they comply with laws, right, that are in effect to minimize fines and financial penalties, those types of things. Right? Okay. The fourth objective says identify audit considerations for observing physical inventory count. So one of the things we're going to talk about in this chapter, which always goes on during an audit, and that as management members, I'm sure you'll be involved in, if you do have an inventory that's manufactured or for resale, there must be an inventory count at least once per year. In many businesses, this occurs right at the year end of the company. The auditors, of course, are very concerned that the physical inventory is accurate, because that's going to reflect the amount of inventory that is recorded in the financial statements. And auditors are aware that the manipulation of inventory is one item that can change significantly the amount of income in a company in a year. Because remember, inventory is part of what we call the cost of goods sold model. The cost of goods sold model simply says you take your beginning inventory, you add your purchases for the year. At that point, you have what's called cost of goods available for sale. Then you deduct your ending inventory at the end of the year, and the balance is your cost of goods sold. So those components, again, beginning inventory plus purchases equals cost of goods available for sale, minus ending inventory equals cost of goods sold. So you can see in that equation, if you change your ending inventory, it's going to change your cost of goods sold number. And if cost of goods sold changes, that's one way to, of course, significantly impact the net income of a business. So auditors are aware of this risk, and under generally accepted auditing standards, a physical inventory count must occur. Okay, it's not optional, it must occur. Again, auditors are concerned that income is reported fairly, right? So if you think about an income statement for most companies, the largest expense during the course of the year is cost of goods sold. So auditors are very concerned about ensuring that the cost of goods sold is accurate. Now, we've already talked about the fact that when we talk about purchasing, it's just not purchasing small items, right? It's purchasing assets. So property, plant, equipment, maybe purchasing another business, buying goodwill. These are all purchases, right? So what types of procedures do the auditors use for these types of assets? So we'll talk about that during the course. And one thing to keep in mind is purchases of property, plant, and equipment and intangible assets. How often would that occur in the normal course of a business, right? During any one year? How many times would the company buy land and building? It wouldn't be very many times, would it, in the course of a year? How often would they buy equipment? In most businesses, unless if you're a large public company, it could be quite a bit of equipment purchases. But if you're a small or mid-sized privately owned business, typically your equipment purchases do not occur that frequently, right? So with respect to these types of purchases, you have large dollar amounts, but infrequent or irregular purchase, right, in terms of timing. So for these types of purchases, the auditors normally put very little reliance on internal control, because it's easier just to go and do a substantive test. So if a company bought a piece of equipment, right, one piece of equipment during the year, why go and study the internal control system, right, and determine whether the risk is high or low on internal control in order to verify that one piece of equipment that you purchased during the year? Just go to the invoice from that supplier, right, and then perhaps trace that invoice to the actual machine, physically see it, right? You can probably do that test in 15 minutes or less. And so that's a lot faster than evaluating the internal control system. Internal control systems, normally we want to look for transactions where there are many transactions, right, that occur during the year. So normally in that case, you're looking at purchase of raw materials, right, purchases of inventory for resale. That would occur multiple times. If you think about a company like Walmart, right, they would purchase many different items during the course of the year, right, for their inventory that they resell. So when you have many transactions occurring very regularly in the accounting system, that's where the auditors want to put internal control reliance. For the other types of purchases, which are infrequent but large dollar amounts, the auditors normally just go straight to substantive procedures and test these purchases, property, plant, and equipment, and intangibles, purely on a substantive basis because it's faster, right? And if it's faster, it means it costs less money. And we'll talk about that more as we go through the chapter, okay? Now, in this particular cycle, when we think about audit risks, remember that auditors want the financial statements to present fairly. And the risk that they're prepared to take that the financial statements do not present fairly is a maximum of 5%. So the auditors know in this particular cycle, purchases, payable, and payment, they have a particular risk around the completeness assertion. Right? When we talk about completeness with respect to payables, what we're talking about is, are all the liabilities recorded that should be recorded? Right? Has management understated some of the liabilities? Well, why would management want to understate the liabilities? Well, because that's one way to manipulate income, right? If management incurred an expense, right? So let's say they had a large legal bill, right? $100,000 legal bill. So maybe the journal entry should be debit legal services, credit accounts payable. But if we don't record that invoice, then we don't record the legal expense, do it? If we don't record the legal expense, that means our profit is higher by $100,000 because we did not record that expense. Well, that's the problem, right? From an auditor's perspective, we're saying the liabilities are complete. And because this area is subject to management manipulation, right, by not recording all of the liabilities, that's why the auditors will conduct quite a few procedures to search for unrecorded liabilities. Okay, so just the latter part of point 6 here. The auditors use procedures to search for unrecorded liabilities because auditors cannot just trust management, right? Do the auditors trust management? In the context of if they don't have other reasons not to, sure, they will trust management, but you cannot, right, conduct an audit and say, we just trusted management. That's not what you're being hired to do. Right? You're being hired to express an opinion on the financial statements based on the audit evidence you have gathered. So just by saying, we trust management, we'll sign the financial statement, you have not yet gathered any audit evidence, have you, to support your audit opinion. So just relying on management would not be, of course, sound evidence in a court if something went wrong and the auditors were sued. We're going to spend some time looking at the internal control questionnaire, just like we did in chapter 11. There's an internal control questionnaire for the purchase payable payment cycle. And again, it's broken out the same way as we saw for revenue. You'll see a reference to general or environmental controls, and then you'll see a breakout for application controls as they apply to each of purchases, application controls as they apply to payables, and then application controls as they apply to payments. And those application controls, right, are broken out by the various management assertions, accuracy, completeness, etc. So again, we'll look at that in a few moments. Okay, excuse me for a minute. Just gonna take a drink of coffee here. Okay, we started off talking about understanding the payable payment process. And this is on page 513 in the text. If you want to sort of follow along in the text as we're talking about these various components. When we make a purchase, what is our entry into the accounting system? Well, it depends, right? It depends on the nature of the purchase. If we're purchasing an asset, we're going to be debiting some type of an asset account, debit land or debit building, right? Or debit office equipment, etc. And then credit accounts payable. If we paid for the purchase right away, our credit would be to cash. But in most systems, you're going to credit accounts payable first, and then later on, you're going to actually pay the accounts payable. Or if we make a purchase, but we did not acquire an asset, then it's going to be some type of expense account. Right? When we make a purchase, it's one of the two things. It's either going to be an asset. We're buying something which is going to last for give us significant benefit in the business, will last more than a year. If it's not that type of an asset, then the only other journal entry in terms of a debit will be debiting some type of expense account. With respect to the objectives of a sound internal control system, as it applies to the purchase payable payment process, we see listed here, are the purchases, payables, and payments, are they valid, right? Did they actually occur? If they are valid, are they recorded accurately? And of course, with respect to any purchase, we want to ensure that purchases do not occur unless they're properly authorized. In addition, a key issue around internal control for the purchase system is when we do purchase something, is it properly classified, right, as an asset versus an expense? And again, this is where management, unfortunately, sometimes in the past has committed frauds and has manipulated the purchase system. If you want to inflate your income, one way to do that is rather than debiting expense accounts when you make a purchase, debit an asset account, right, and hide your expenses in asset accounts. So this has been the subject of a number of frauds in recent years where auditors, because of the nature of the business, failed to detect that management was actually manipulating the financial statements. Then in terms of the assertions, right, the key assertion from an audit risk perspective is completeness. If all the liabilities are not complete, right, meaning that they're not all recorded, our expenses might be understated. Right? If our expenses are understated, that means the profit is overstated, which of course is not good. If our liabilities are understated, it might mean some of our ratios in the financial statements are understated. So if we should record more debts, right, that means our debt to equity ratio is understated. If we have borrowed money, and one of the covenants or conditions is we have to meet certain debt ratios, right? If we're in trouble and we think our debt's going to be too high, just don't record the debt, right? That would be one answer. Don't record the accounts payable in order to keep the debt to equity ratio lower. Okay, so again, from an audit perspective, the auditors are very concerned and want to ensure that all the debts are recorded, both from an income statement perspective to make sure that profit is not overstated by ignoring, right, the accrual of liabilities, and then on the balance sheet, of course, to ensure that the financial picture is properly presented. Another example on the balance sheet would be, let's say some of our accounts payable are not recorded. So when we look at the amount of working capital in a business, it might be misstated. Working capital is current assets minus current liabilities. Right? So, well, if current liabilities are understated because we haven't recorded all of our accounts payable, it makes working capital look at a higher number than it actually is, right? So that could be misleading. And of course, when we take the ratio, current ratio or working capital ratio, current assets divide by current liabilities, if the current liabilities are understated, the current ratio will be a larger number than it otherwise would be. And so all of these things could be misleading, right, to the user of the financial statements. So again, from an auditor's perspective, the risk is around the completeness. Okay? Remember, at the end of an audit, when the auditor signs a financial statement saying that the financial statements present fairly, right, people are going to be relying on that, right, to make decisions. So auditors are very concerned that a fraud not be occurred, right, by management. Okay. The next PowerPoint talks about understanding the triple P process, right? I'll just refer it as the triple P so I don't have to keep saying purchase payable payments. So whenever I say the triple P process, I'm talking about the purchases payable payments process. Now, one key aspect, of course, when we purchase items, whether we're purchasing assets or purchasing services, incurring expenses, it's going to affect the amount of cash, right, that we are spending in our business. And so when we want to ensure that our cash is sufficient in operating our business, what do? We do cash flow planning or projections. So this is one of the most important aspects, actually, of controlling, right, the purchasing that's taking place inside of a business organization. And that's why in the PowerPoint, it refers to the fact there should be a high level of management planning and control around the use of cash. Why is that? Well, you probably know, right, from your own personal circumstances, is cash unlimited? Right? In the old days, we used to say, does money grow on trees? No, right? We have to earn it. We have to work, right? In order to earn money for our families and to buy food and all the other things that we want to buy, right, during our lifetime. So we have to work. We have to earn things. Well, in a business, of course, you want to make sure, just like in our personal lives, you don't want to run out of money, right? So if you think about your own personal circumstance, right, have you been at a time when you were concerned about, am I going to have enough money or not? Right? Am I going to have enough money to pay my rent next week? Am I going to have enough money to pay my tuition installment next week? Am I going to have enough money to go on vacation next year? All these things, right? We're asking ourselves, am I going to have enough? Am I going to have enough? And we know we ask ourselves that question because we want to make sure we do have enough and we don't run low on our cash. Well, businesses are the same way, right? Excuse me. When at the current time, I've got two of my own children, right? They are CFOs for different organizations. So in the Windsor area here, we have a college called St. Clair College. My oldest son is the CFO at St. Clair College. And my daughter, she's the controller for a company in Dallas, Texas, involved in the food industry. And I've mentioned to both of them, and they do this from time to time, I said, one thing you want to do in terms of running your organization is project your cash, right? How much cash are we going to have in the next? And I usually tell them, try to project at least 6 months ahead. 12 months is better, right? Think about your own personal life. If you project your cash position over the next year, you can sort of plan around that, can't you? But at least you have to consider the shorter term, right? Am I going to have enough money for the next 6 months, right? So we're in March now. And if we said, if we projected our cash to the end of August, for many of us, that would be okay. We probably want to have a longer term perspective to some degree, but certainly we have to have enough cash in the next 3 to 6 months. So why I've always advised my own children that always be looking ahead, right, at least 6 months minimum, preferably a year. Now, the reasoning behind that is that if you're going to run out of cash or your cash balance is going to run too low, then you have at least 6 months to fix it, right? You have some time to deal with the reality that you're going to run low on cash, as opposed to, right, waking up one day and saying, oh, gee, we're short of cash today, or gee, we're going to be short of cash next week. We can't make our payroll. Right? All these things could be very, very negative. But by looking ahead, at least 6 months and preferably 12 months, you can avoid landmines, right? Avoid problems in business by taking action to correct the situation. Right? If you think your cash is going to run low, spend less, right? That's one way to increase cash, decrease what you're spending, right? On the other hand, you may have to look at ways, how can I increase my cash? Well, if I'm working, maybe I have to work, 20 hours a week instead of 15, right, to generate some more cash. Or you may be in a situation, if your parents are helping to finance your education, I have to ask them for a little more money, right? Because my expenses are higher than I thought they might be, right? And things like this. So we are going to look at our various sources of cash in our business, and of course, in our personal life being a business, and we have to project ahead and manage the amount of cash. And as we do that, what are we doing? We're planning our cash position to make sure we don't run out, but then we're actually controlling, right? Aren't we? We're controlling the purchasing, aren't we? And when we're controlling the purchasing, we're controlling the amount of cash going out, right, that we're spending. So it's my own grandfather, he's passed away now, but one of my grandfathers said to me, it's not how much money you earn, it's how much money you keep, right? And what he really meant was, regardless of how much you might earn, right, you can always spend more than you earn. It's about how much do you keep or how much do you save, right? And if you save money, what does that mean? You purchase less, right? So it's really about, it's not so much how much you make as it is how much you purchase or spend, right? I've had I know the business people. He was a client of an accounting firm where I used to work in the past, and this person made $1 million a year. Okay, so this is about 20 years ago. He was a professional person, and he was making about $1 million a year. He ended up going personally bankrupt. Why? Because he was spending $2 million a year. Right? He had such a good lifestyle. He was just outspending himself, and then he couldn't pay his debts, so he had to declare bankruptcy. So, of course, that's my grandfather's story. It's not so much how you earn, it's how much you keep. You have to control your purchases, right, in order to ensure that you're in a sound financial position. And that's the same in a business as it is in our personal lives. Okay. The next PowerPoint, we want to talk about risk assessment in the purchase payable payment process or accounting cycle. And this is discussed on page 515 in the text. So we want to understand the business that we're operating in, right? So auditors auditing the financial statement. We've mentioned before, one of the most important things is they must have good knowledge of business, right? If you understand your client's business, right, you're going to really have a deep understanding of the accounting processes in that business. And the same thing as a member of management, right? If you understand the business, right, in terms of how the company operates, how it makes money, right, the different forms that are used in the business, you're going to have a very good knowledge level of your company's internal control processes and how they provide comfort to yourselves as members of management, but also to auditors around specific risks. And that's what they mentioned in this PowerPoint, a number of specific risks the auditors will look to be controlled in this particular accounting cycle. So the first one, existence, right? With respect to existence, from an audit perspective, they're looking at inventory. And if inventory is recorded on the balance sheet, does it exist? If it doesn't exist, it means inventory is overstated. Similarly, with respect to property, plant, and equipment, have we properly capitalized our purchases? Right? So the assets that we recorded as land building equipment, are they really land building and equipment? Or do we record some expenses inside of our asset accounts? So a typical example of this in the accounting process would be repairs and maintenance expenses, right? So if we perform some type of a repair on a piece of equipment, should that cost be written off as a repair and maintenance expense, or should that cost be capitalized, meaning added to the asset cost, right? So that's one of the issues we have in accounting is which repair and maintenance costs are capitalized and which ones are not. Right? If repair and maintenance costs are improperly capitalized, it means an asset does not exist, right? To the extent that our capitalization of expenses is not appropriate. Secondly, we're concerned around ownership of assets, right? So when we record inventory in the balance sheet, does that include inventory which is on consignment? And so sometimes, if you think about a pawn shop, would be the best example of this. Pawn shops do not generally purchase inventory. What they do is people that want to sell things, pawn shops will take inventory on consignment. Okay, so that just means they hold it right in their store for the owner, and when the item is sold, they get paid a commission, right, for selling the item. They never actually purchase the item on inventory. Okay, so when we do have inventory recorded in our financial statement, we want to make sure that it is ours, right, that we own it, and that it's not someone else's inventory. In addition, when companies purchase services, are they for business purposes or was money spent for personal items, right? So personal items, of course, should not be recorded as purchases expense in a business. We want to, owners of businesses can buy things and use company money, but it has to be charged to their own account, right? It has to be set up as a receivable from the shareholder. It's not an expense of the business. Completeness of liabilities, we've already talked about, and again, we'll come back to that a bit later in the chapter. Valuation can be an issue in this particular cycle. So do we have internal controls to address valuation risks? So one of the major valuation risks is obsolescence, especially obsolescence of inventory. Do we have inventory recorded in our balance sheet that we can't sell? Management might prefer to carry forward, right, their obsolete inventory in their balance sheet because if they reduce their inventory, they have to charge that cost to cost of goods sold, right? And if cost of goods sold increases, that means their profit is going to decrease. But from an auditor's perspective, of course, you don't want inventory to include obsolete items, right? Remember, inventory under IFRS is recorded at the lower of cost and net realizable value. Well, for obsolete inventory, net realizable value might be zero, right? The item might have cost us $50, but we can't sell it because it's old, right? And so auditors are concerned about whether management has properly valued their inventory or not. Have they overlooked, right, some of these obsolete items? Now, one of the things we'll talk about a bit later in the chapter, we've mentioned already, are inventory counts. The auditors want to ensure that the ending inventory recorded in the company's financial statement is accurate, right? That it does not include obsolete items which are improperly valued. So one of the ways, of course, auditors determine this is that at the end of the year, during the physical counting of the inventory, the auditors just walk around and actually physically view the inventory, right? And so if you see some inventory, maybe sitting in the corner of a plant, right, of a manufacturing building, it's just sitting in the corner, right? It has 2 inches of dust on it. Well, you know that inventory hasn't been moved for a long time, right? So you're going to be asking management about that inventory and saying, hey, what are those items? You know, how have they been valued in the inventory? 2 inches of dust looks like they haven't moved in a long time. And so probably the net realizable value of that inventory might be zero. Right? So the physical count allows the auditor to walk around and view things, right? So we call that auditing by walking around, right? You can discover a lot of information as an auditor, as a member of management, by walking around, right? And having an eyes open approach in terms of looking at and learning about what's going on in our business. And then the last item, disclosure. Disclosure is a concern. We need to have internal controls in our business to ensure that all
purchases and related commitments are disclosed. Because if we fail to disclose contractual commitments, people may argue that the financial statements did not present fairly, right? So if we fail to disclose perhaps that we have purchase commitments, right, for raw materials going into the future. So sometimes large manufacturers, in order to secure, right, a raw material source, they will actually give a blanket purchase order for the next 12 months. A blanket purchase order simply means that they guarantee, right, their supplier that they will purchase a certain amount of material in the next 12 months. And then the basis of that purchase order, the supplier says, yes, you're buying $50 million, right, of items from me, so I will give you a certain price, right? And that's a lower price than if you only bought $5 million of goods from me, right? So, of course, businesses, they will negotiate with their suppliers to get the best price that they can, right? But when a business has ongoing contractual commitments, we want to disclose those. Why? Because it affects future cash flow. Right? If a company has, as I mentioned, blanket purchase orders, right, for the future, or if a company has lease obligations on buildings or equipment in the future, we want to disclose what those lease obligations are. Okay. Of course, we will also have debt obligations to pay. Right? We might have borrowed money on a bond as a bond payable or as a mortgage payable. What are the principal repayments required for that debt over the next 12 months, over the next 5 years, over the next 10 years, right? So users want that information so they can do what? Address the cash flow in the business, right? Is it going to be adequate or not? Or if we have large amounts of debt coming due, right, in the near future, and we don't have enough cash on hand to service those debts, how are we going to fix that problem? Right? So disclosure, right, could be very important from a user perspective in terms of looking at, again, ratios, right? If debts are understated, debt to equity ratios are wrong, current ratios are wrong, right? All of these things could significantly impact the financial statements and mislead the users. Okay, so our first step on page 517, and we've seen this in the sales cycle as well, is we want to have an understanding of the purchase payable payment process. So Exhibit 12-1, again on page 517, if you want to turn to that in your text for a minute. You'll see on that page, there's a description, right? And again, it's just a general description, but it shows you the various components involved in this particular cycle. So let's just walk through the cycle for a moment. So you see the red dot, it says start here, right? So when we're going to purchase something, what do? We issue a purchase requisition, right? That goes to the supplier. The requisition is simply a form, internal form, that says we need to purchase something. We need to purchase some more paper, right? If we're an accounting firm, we need to buy some more paper, right, for our office. So someone is going to approve that requisition and say, yes, we do need more paper. So then a purchase order will be created as a result of that signed purchase requisition. The purchase order goes to the supplier, right? Because that's the notification from the buyer to the supplier. We need, X pieces of paper. We want to buy 100,000 sheets of paper from you, or whatever that is. The purchase has been authorized internally, right, to generate the purchase order, because you want to ensure authorization occurred, because there's going to be a use of money, right, in the future to pay for this purchase. So before we even enter into the purchase, we want an assessment that we actually do need the item. When the items come in, right, from the supplier, that paper comes back into our office, we're going to produce a receiving report. Right? So that where the receiving report says, yes, we have received $100,000 or 100,000 sheets of paper. Okay, and then once we receive that report, of course, we need to ensure that the paper is properly protected. Right. So I think about years ago when I worked in the Toronto office of one of the major audit firms. At one point in time, they used to keep their supply room open. So in the supply room, you could get paper, pens, right? A lot of different forms that the firm used. You could just walk in and help yourself. Well, eventually they had to lock the supply room. Why? Because paper was disappearing, pens were disappearing. People were walking in, helping themselves and taking things home, right? Was the allegation. If they had kids, right, they'd take paper home for their kids to use or take pens home for their kids to use. So the supply costs, right, was getting out of hand because assets were disappearing, right? So you need to have proper custody, right? Custody over the asset to protect it, right, from disappearing. Now, when you produce that receiving report internally and have proper custody over the physical goods, the supplier eventually is going to invoice you, right? So you receive a supplier invoice. And when you receive that supplier invoice, what do you want to do? Internally, the account payable for the paper purchased in my example will not be recorded until 3 items are matched. The purchase order, which is our order to the supplier for how many items we wanted to buy at what price, okay, should be matched to the receiving report. So did we receive what we ordered? Okay, and that'll just be in quantities only. And then the supplier invoice is going to state the number of items for which we were invoiced. So the number of items we were billed for by the supplier, does that match the purchase order in terms of what we ordered? And does it match the receiving report in terms of what we actually received? So if our purchase order said, send me 100,000 sheets of paper, the receiving report we generated internally said, yes, we received 100,000 sheets of paper. Then we get the supplier invoice for 100,000 sheets of paper. Everything matches. Once those documents are matched, then the account payable is recorded. Okay. But so the key control over recording of accounts payable is the matching of the 3 documents. Okay. And we'll state that several times. So when we record the accounts payable, that's the record keeping part, of course. Once we record the accounts payable, of course, eventually we have to pay the accounts payable. So we're going to typically write a check, right? Many companies still write checks, or on occasion, they'll pay by electronic funds transfer. Right? And that's becoming more and more common, of course, as we generally in society tend to move further and further away from handling of cash, and whether that's physical cash or even writing checks, right? Easier to do electronic funds transfer, so we're digitally transferring money, right? And of course, we know all about digital currencies today, and as opposed to dealing with currency. So that'll be interesting to see how that is dealt with going forward. Now, you also see on page 517 many reports, right, that are issued. So on the right-hand side, you see there's going to be, of course, documents produced, the purchase requisition, the purchase order, the receiving report, all come in. On the left-hand side, you're going to see the various reports, an accounts payable file. Right, that's going to be used to generate an accounts payable listing. Right, who do we owe money to? As we pay the accounts payable, there'll be a listing of payments made, right, checks written to the suppliers and the amount. Okay. And of course, each month, again, coming back up to where it says start here at the top of page 517, just to the left, we see an item called reconciling. So we want to reconcile a number of things. All the payables that we recorded when the goods came in, we want to reconcile our listing of accounts payable to our general ledger control account for accounts payable in the general ledger, to make sure that those two are balanced, right, on a monthly basis. We also want to reconcile our bank account, right, to ensure that our bank account balance is accurate in terms of, does our bank account balance between our general ledger and what our bank statement says, right, from the bank. So of course, reconciling our bank account is right an extremely important process to ensure that our cash is being properly controlled. Many businesses that I've seen that have suffered over the years and eventually, in some cases, went bankrupt, it's because they failed to properly control their cash. They failed to do their monthly bank reconciliations on a timely basis. Right? So all of these things, of course, broke down their internal control system, and eventually they lost money as a consequence of that. Okay. So I think what we'll do now, we've been going almost close to an hour. So let's just take a 5-minute break or so. Okay, I'll be back in 5 minutes and we'll continue on with today's lecture. I'll be back in 5 minutes. Thank you. Okay, everybody, we'll continue on talking about our triple P system. So we want to, again, it might be handy if you just look at page 517, the normal parts of the purchase payable payment cycle as we walk through the various controls that we want to have exist in this cycle. So the first one, as we saw in the sales cycle, authorization. So purchases should be made by purchasing departments or authorized purchasers. So this creates control, right, over items which are being purchased. One example of a purchasing control would be that we have to have competitive bids. So for amounts that are over $1,000 or whatever the appropriate limit might be in a particular business, nothing is purchased unless we have competitive bids. So competitive bids, right, controls the amount of money that's going to be spent by the company. And so authorization is going to occur as a result of obtaining a competitive bid. But again, we have people in charge, right? Typically in a large company, we'd have a separate purchasing department, or in a smaller business, you'll have an individual charged with purchasing items for the business. In addition, in terms of authorization, we're going to look to see that disbursements are authorized by someone in charge of accounts payable. Again, in a large company, you would have a separate accounts payable department. So nothing gets paid unless authorized by the accounts payable department. And what I mentioned a few minutes ago was nothing will be paid until 3 documents are matched, right? The purchase order, being how much we wanted to purchase from the supplier, is matched with the receiving report, how much we actually receive from the supplier, which is matched to the actual invoice from the supplier, what we're being billed for. Right? Those 3 documents have to match before a disbursement is approved. So that's one control over disbursements of cash, is the matching of the 3 documents. That's the most important control in the purchase cycle. In addition to that, we can control disbursements by ensuring that checks must be signed by authorized personnel. Right? So very typically, of course, that tends to be people who are high up in terms of the corporate ladder. So at least for large amounts of money, typically a vice president and or president of the company, but for smaller amounts, perhaps the controller and another individual would be able to sign checks for smaller amounts. So normally you have various authorized limits by which certain people can actually sign checks, okay, on behalf of the company. The next control we mentioned was when you receive goods in a business, you want to have control over the physical goods, right? So some type of custodial control. So in a large company, you would have a separate receiving department, right, to actually receive the goods from the supplier and to forward those goods to the department that ordered the goods. Okay. In addition, of course, in a business, you want to have custody over the cash. No, it says custody of cash. What they really mean is the custody of cash in the company's bank account. Okay. Who can control access to the bank account? Well, again, you want control over the actual cash, the custody of the cash in the company's bank account, by having appropriate persons able to sign checks. Right? So typically, someone lower level should not be signing checks for the corporation. They don't have knowledge, right, of the type of things that are being purchased, why they're being purchased, or whether they should have been purchased. Normally, it has to be someone higher up in the corporate level of responsibility that'll have responsibility for signing checks. One of the things to also keep in mind with respect to custody is custody over blank documents. Right? So if you have checks, right, that you order in advance. So typically when a company orders checks, it doesn't order 100 checks. It might order 1,000 checks. It might order 10,000 checks all at once. So when those blank checks come in, you have to have custody or physical control over the blank checks, right? Because you don't want someone to be able to take a stack of checks home with them and start, right, creating payments to themselves or to other parties using company checks, right? And they would falsify, of course, the signatures on the checks. So in order to have proper custodial control over blank forms, you might have to store them in some type of a vault, right, or some type of other locked area, right, just a locked room, a locked drawer, right. So in a large company, typically they would have a vault, and normally they keep all their blank documents in that vault. So custodial control over the physical goods and other items. Okay, sorry. Sorry, everybody. I had to restart my computer system there because as you're aware, I'm sure my computer froze up on you. So just to finish off my discussion around custody, when we think of custody, normally we think custody of just of physical goods, right, arriving at business premises, but custody over the money in the bank account, and custody also over blank documents, right? All three are extremely important in terms of ensuring proper control, right, over the assets of the business. In terms of recording, again, the matching of the documents. Once the three documents are matched, being the purchase order, the receiving report, and the vendor invoice, then we record the actual accounts payable. Right? We're not going to record a liability until those three amounts are three documents are matched together. Another control over the recording function is that when checks are actually prepared, the disbursement is recorded. Okay, so one of the issues that sometimes businesses run into is when they start if they're in financial difficulty, very often they'll prepare checks but not actually send the checks to the supplier, right? Well, when the checks are prepared, right, they may not be signed yet, right? But once they're prepared and signed, they should not be held on site, right? The disbursements should be recorded once the checks are prepared. Sometimes I've seen clients that are in financial difficulty, they go ahead and prepare the checks, but then they just hold them, right? They don't actually mail them to the supplier. Well, even though you haven't mailed them out yet, you do want to record them. So you have a record of the checks that you've actually prepared, right, and have been signed. And then you can, of course, reconcile from your general ledger, which will have recorded the checks, to the actual bank statement, right? So the outstanding checks, right, will show up on the bank reconciliation because you have recorded them as a disbursement. but they have not yet cleared the bank, right? Because you have not even mailed them out yet. So it's a way to maintain proper control over checks prepared that have not yet been mailed out. So very often when companies, as I mentioned, are in financial difficulty, they get into the situation where they prepare checks, but they don't actually record them, right? So they're pretending they haven't actually issued the check, but all the documentation is done, they've been signed, they just haven't been mailed out. Okay. So if they're on hand still, we know checks on hand are not counted as being outstanding. That's probably why, right, they don't want to actually issue the check. But you can lose control over the checks prepared if you don't actually record them as being issued. Okay, so best practice is once a check is prepared, actually record them as a disbursement. Whether you actually mail them out or not, that's another issue. Okay, and the whole recording control, that's on page 516 in the text. Okay, the next one, periodic reconciliation. I've mentioned this already in passing. So the reconciliation of assets to amounts which are recorded, right, is a very important control over the assets of a business. And so if we think about the context of the purchase payable payments cycle, what types of assets might we be talking about? Well, physical inventory, right? Inventory is purchased. And so we will have inventory on hand. So we want to reconcile the actual inventory on hand to the general ledger accounts to ensure that they're the same number. Bank reconciliations, right? We've already mentioned. One important control over the amount of cash in the business is to make sure that the amount of cash recorded in our general ledger corresponds with the amount of cash that we have in our actual bank account. We also want to compare capital assets or fixed assets to our general ledger accounts to ensure that they exist. So especially with respect to new assets acquired during the year, you normally want to physically see them, right? Because we've spent a lot of money to purchase them. So we want to ensure that they have actually arrived before we start paying for them, right? So that's very common, of course, to verify our additions to capital or fixed assets during the year. But then also on occasion, sometimes where companies lose control over their fixed assets is they will make dispositions of minor assets, but not account for them properly. Okay, and over many years, the capital assets in the general ledger can become misstated because we've disposed of minor pieces of equipment and not relieved, right, the original cost out of the general ledger accounts. So you wouldn't do this on an annual basis, but maybe every 5 years it would be a good idea to do a physical count of your fixed assets, right? Because even small pieces of equipment can disappear over time. Okay, so I have known companies where they've done a count of their capital or fixed assets and adjusted, right, their general ledger to write off costs of equipment that was they no longer physically owned. Then, in addition to reconciling their bank account each month, we want to reconcile our accounts payable, right? So as we're purchasing items, we're recording debit purchase credit accounts payable, and we want to reconcile the detailed list of our accounts payable, what we owe parties, to what we have recorded in our general ledger. So there's actually a lot of reconciliation going on here, right? Reconciling accounts payable detail in our accounts payable subledger to the general ledger. Reconciling our bank account helps to ensure that our bank account balance is correct. The reconciliation of accounts payable helps to make sure that the accounts payable process is correct. Reconciling, of course, our inventory that actually occurs to our general ledger helps to ensure the accuracy of our accounting documents, right, of our accounting. So if we weren't doing all these reconciliations, it's a way for errors to creep in, right, to the accounting process. But by reconciling, we keep the accounting records We use the term clean, accurate, and plus we know it's a way to keep control over the assets themselves. If people know we count our inventory regularly, they're less likely to steal things, aren't they? If people know that we reconcile the bank account at least monthly, they're less likely to steal cash because it may be discovered quickly. Right? If people know every few years we reconcile our fixed assets, they'll be less likely to take them. Okay, so just the idea that in the accounting functions, people know that we're doing these reconciliations. That's a control over how people think and what they will do. Now, one of the very important aspects of auditing today, of course, is dealing with accounting information systems. And this is discussed on page 518 in the text. We saw in the receivable receipts revenue cycle that management reports, right, are produced, which give a lot of information. And the same thing happens here in the context of the purchase payable payments system. So the processing of the purchases and the accounts payable and the payments in our information system will produce various types of management reports. Those management reports, of course, can be used as audit evidence. And so they might provide us with keys to problems in the accounting system. So for example, you could have a management report in this PowerPoint about open purchase orders. What is an open purchase order? An open purchase order is a purchase order that has not been filled yet, right? So we have not yet matched the purchase order with the supplier invoice, right, with the receiving report. Well, we may have already received the goods, right, but just failed to match the goods with the purchase order. So we might have concern over whether all the accounts payable are recorded or not if we have open purchase orders, especially open purchase orders from weeks or months ago. And so this might provide us with an issue to follow up with respect to the completeness of accounts payable. Unmatched receiving reports. If we have receiving reports that have not been matched to purchase invoices, that might question the validity of purchases. Right? If we receive goods for which there was no purchase order issued, right, that's an indication that we're buying things which are not authorized. Okay, and if we have unmatched receiving reports, there could be unaccrued liabilities. We've received goods, but maybe we haven't received an invoice yet from the supplier. But if we've received goods, we actually do have a liability. This is one thing my daughter in Texas ran into when she took the job as controller for this food business. They were, in order to produce their monthly financial statements, it was taking them about 20 or 22 days, right? So, for example, if their month end was February 28th, they would not have their February 28th financial statements for the month until March 20th or March 22nd. So, of course, that was one of her jobs, was to improve the financial reporting cycle. So she started looking at it, and she was talking to me about it. And I mentioned to her, I said, well, from what she told me, I said, it sounds to me like there's a problem in the accounts payable department. I said, my guess is that you guys, the company is receiving goods, okay, so they have receiving reports, but they're not recording the liability until they actually receive the invoice from the supplier, which might be several days or several weeks later. And I said, if what they're doing is they're holding up the production of the monthly financial statements until they actually get the supplier invoice, okay? And I said, you don't have to do that, obviously, because you could, if you receive the goods, you can record the liability based on the purchase order, right? If the purchase order quantity matches what you received and you know what the price is, you can just set up an accrual entry, right? Debit purchases, credit accrued liabilities. Then the following month, when the invoice comes in, you debit accrued liabilities and credit accounts payable. So yes, when she investigated, she discovered that was the problem, right? The accounts payable department was just refusing to close the month end because they did not have invoices from suppliers. Well, as she pointed out, you don't need invoices from suppliers. You can simply accrue the liabilities. And so that's what they did. They started accruing the liabilities at the end of the month as opposed to waiting for the actual invoices. Because again, this company, does $800 million in sales. So if their accounts payable are, out a little bit, it's not going to matter when they set up their accrual. So she was able to get their financial reporting process shortened from 20 or 22 days after the year end. Now they're producing their month-end financial statements in less than a week. Okay, so their February 28th month end they'd have before March 7th. So very fast, right? So she looked like the star, so that's good for her. But it shows you the type of problems you can run into. Okay, so when you have unmatched receiving reports, yes, they did have an unaccrued liability, right? Their problem, though, was, as I said, they were delaying the processing of the monthly information until they actually got the invoices. You don't have to. If you have an unmatched receiving report, you've received goods, you have to record the liability. But of course, you receive goods, yes, you have a liability, but was the purchase authorized or not? It may be an issue, right? So you might have to follow up that internal control weakness, or it's an apparent weakness. How about unmatched supplier invoices? So if you receive invoices from a supplier, it may be an indication you've actually received the goods, but maybe the receiving report has gotten lost or hasn't been processed. So again, it may go towards unaccrued liabilities because keep in mind, you don't record the liability until you match the purchase order with the invoice from the supplier with the receiving report, right? But if you have invoices which are not yet matched to the purchase order, maybe a purchase order doesn't exist, right? So that questions, are you buying things which are not approved? It goes to the authorization issue. And then if a supplier has invoiced you, presumably you've received the goods, right? So there could be, again, unaccrued liabilities, okay? And of course, you go and walk through the various remaining management reports here, but the idea is that these reports can be valuable because they give you hints or ideas on what to follow up, right? Especially the first three, open purchase orders, because you're talking about lack of matching, right? And what I've said several times even today is the matching of those three documents is the key control, right, in the purchase payable payment cycle. The purchase orders have to be matched to the receiving reports, which have to be matched to the supplier invoices, right? And if you have unmatched documents, it's just an indication there could be something wrong in the accounting process. Okay. Which gets us to the next phase of what we'll be discussing in this particular section of the lecture, control risk assessment. So as we did in the revenue receivable receipt cycle, we know that in the accounting cycle, when we look at our controls, right, we have to assess the risk. The risk is whether the internal control system will detect, prevent, and correct a material error should it occur in the financial statements. Why do we have to assess risk? Because whether the internal control system is good or poor will affect the nature, the timing, and the extent of our substantive procedures. Now, we mentioned earlier, with respect to the purchase payable payment account, we want to look at all the accounts involved in this cycle. So which accounts are involved in this cycle? So you see a listing here, okay? And these items are listed on page 521 in the text. Inventory, of course, we've already talked about inventory being purchased. Fixed assets, so land, building, equipment of various types. Intangible assets such as goodwill, patents, copyrights, licenses, right? These are all intangibles. One thing we'll talk about next day is the recording of depreciation and amortization on capital assets, right? So the purchase payable payment cycle, we want to ensure that the correct amount of cost is recorded for our depreciable assets, because that's going to affect the depreciation and amortization expense we record on those assets. Of course, we know depreciation and amortization is recorded in an accumulated account, right? We accumulate that over time, and it's reflected on the balance sheet. So on the balance sheet, we show our capital assets at their net book value. So the accuracy of accumulated depreciation and amortization, very important. Accounts and notes payable, of course, we've already been talking about today. The payment, right, of the accounts payable, part of the cycle. So that goes towards the reconciliation of the bank account, being a key control in the purchase payable payment cycle. And then the expenses, right? Because when we purchase things, if it's not an asset, it's an expense, isn't it? But what type of expense? And so that goes towards proper control over the classification of expenses, right? Is it an administrative expense? Is it selling? Is it manufacturing? Is it a financial expense, perhaps? We have to ensure not only is the expense recorded, but it's put into the proper category, right? That it's properly classified. So we need to have controls in place to ensure that these expenses are properly classified. Okay, so for today, I'm going to stop there because this really starts into the next discussion about the detailed controls in the purchase payable payment cycle. Okay, so next day we'll get into that, and then of course talking about the substantive procedures that we do as a consequence of our assessment over internal control. Okay, so again, what I would suggest for you is certainly review the material that we've talked about today. But right at the end of chapter 12, what I would suggest is that you have a look at the internal control questionnaire, because I will be giving you a couple questions for you to test your abilities in terms of assessing internal control. Okay, just like we did in the revenue receivable receipt cycle. And by the way, I will be posting solutions for the two discussion cases I asked you to look at. I'll be doing that today. But on page 566, okay, is where you'll see the internal control questionnaire for the triple P cycle. And you'll note that it deals with the overall company level controls, and then application controls for each part of the cycle. So at the bottom of page 566, you'll see the purchasing and accounts payable application controls. So it talks about the general controls, and then over on the next page, it talks about the application controls in each of the assertion areas, right? Validity, completeness, authorization. At the bottom of page 567, it talks about the cash disbursement application controls. Again, the general controls over on the next page. Again, the application controls by audit assertion, right? Validity, completeness, authorization, etc. And then at the bottom of page 568, you'll see the inventory transaction processing controls, right? Same approach, the general controls over on the next page, 569. You have the application controls over inventory. And then at the bottom of page 569, you'll see the heading PPE, property, plant, and equipment assets and related accounts. Again, what are the environmental controls and the application controls over those accounts? So you see here special attention given to inventory. Why? Because it affects the income statement significantly. Special attention given to property, plant, and equipment. Why? Because it's a large dollar amount, right, in the financial statements, and significantly affects income statement as well through the depreciation and amortization process. Okay, and then of course the general purchase payable payment cycle, because it affects all the other expenses and assets that are purchased in the business. Okay, so have a read through that as well. And next day when we go into the control risk assessment, we'll spend some time looking at those together. Okay, thanks everybody. Have a good day, and we'll see you on Wednesday. Take care.